work has to come with you sometimes.
You never get to fully turn off.
No.
Yeah.
No, not at all. You
And
always have
sometimes
something.
when you've got some crazy deals going, you're trying to go to sleep and you can't turn off.
Yeah. Angie was dealing with that last night where she was like trying to come up with the solutions
Crunching
in her head.
numbers.
Yeah, and I was like, babe, you got to relax. Just take it easy. You got to separate.
Well, welcome back, you guys, to Real Talk with Julio Sandoval.
And Matt Beatty.
So since last time we met, the Fed has raised the rates another 75 basis points, which was the biggest rate hike that we've seen since 1994.
Yeah, it's serious. I think people kind of downplay sometimes what's happening in the market, but I mean, this is natural. To be honest, this has been a long time coming. I would say back in 2018, we were looking for price adjustments and rate adjustments, but changes in the economy, there was an election period that was coming around the corner, so it was stalemated a lot. So now because of inflation, because coming out of pandemic, that's all compiled into now where they have to really rip the Band-Aid off.
For sure, man. So in April, the inflation numbers were down, and everybody kind of celebrated, but that was just one data point. And so in May, it surged to a 40-year high, hence this massive rate hike that is going to have significant impact on the real estate market,
Yeah, and your buying capability, and what does that mean, for whether you're buying or whether you're selling, and we'll talk a little bit more about that, whether you're investing. There's opportunities everywhere. It's never, people always ask, is now a good time to buy? It all depends on your circumstance and whether or not you're managing your finances and your scenarios to the best of your ability. We make the best choices possible based on the information, and that's what we're here for. We're here to provide you with that data so that you can make a conscious choice for yourself.
Yeah. So last week, I saw people locking right around 6% on the 30-year conventional, but there was a buy down on that, to get it down to the 6% rate. Is that what you're seeing today?
Yeah, and once again, down payment, credit scores are all going to affect your scenarios. But yeah, you're looking today, Freddie Mac posted that they were showing rates at about 5.875 for the 30-year fixed. The 15 was somewhere at about 4.875, I believe, today.
Yeah.
And so as of this recording, that's what they were showing as far as the rate scenarios.
Yeah.
And we saw some improvement over the last couple of days. So every day changes. Every situation will change depending upon, where you're at.
Yeah. No, it's interesting, man. I really feel the shift in the market away from being a seller-dominated market. I have, colleagues who are posting on our, private group chats. Hey, I've got this listing that a year ago I would have had 10 offers right now, and I have crickets. Help, SOS. And they're priced right.
Yeah.
It's just I feel the market shifting. And the buyers are gaining some more power. So while they're paying more for the loan product, they're paying more for the rate. They're making up some ground there on the negotiations, and the contracts are getting accepted in what I'm seeing.
Yeah, and so combination of effects that's going on for the buyer. You have inflation, which is driving up the cost of groceries, and then you have gas prices surging still, and continuing to go up. So that affects the buyer's capability and what they're willing to spend in the next phase of it. And then you have interest rates going up.
Yeah.
So a double whammy against the buyer. So they're going to be a little bit more conservative and weary about where they're spending their money.
Sure.
But strategies to kind of keep in mind is leveraging some of the seller's equity position to hopefully help incentivize buyers to come in. Before, a seller would never have helped with the closing costs for a buyer. but you may be able to help incentivize a buyer to come purchase your property if you're willing to help them with the buy down on points.
I saw that just the other day. $7,000 credit in the private remarks in the MLS to help the buyer buy their rate down.
Yeah.
$7,000 credit. We would have never seen that this time last year.
Yeah, and that's hence the new market.
Yeah.
And the balance of things. So as a seller, you're looking at your bottom line and trying to figure out what you need to get you to your next property or to wherever it is that you're going next.
Mm-hmm.
And as a buyer, you need help in order to help cover, to help bring down some of those interest rate scenarios.
Mm-hmm.
And that's the whole idea of buying down points. And
yeah.
I think that's something that we should kind of explain. Is it okay if I kind of go through
Sure,
that?
absolutely. Let's go into it.
Okay, so what a point is, and I get this question a lot, is essentially it's the buyer is paying down the interest for their loan by paying an upfront fee. That upfront fee is represented as a percentage of whatever the loan amount is. Okay, so if you hear 1 point, okay, that would be like 1% of whatever that loan cost is. So if you have a $600,000 loan, that would be a $6,000 fee. Okay, so sometimes people are wondering, well, wouldn't it be a flat fee and cost? It's not, and it's a percentage of that loan amount. So if you have a lower loan amount, then you're paying what feels like less in points, even though the percentage is the same. Now, a buyer cannot exceed a certain amount of points in which they buy down because it ends up being what would be called a high-priced mortgage loan situation. And a seller crediting that buyer in that way actually helps offset that cost and keeps them away from the high-priced mortgage loan scenario.
Sure.
See, the government won't allow you to pay too much in points. They want to protect you as a buyer. That was the whole idea after 2008, is to make sure that the buyer is protected, and the way to do that was to make sure that they weren't paying too much for a loan scenario.
Yeah.
So it becomes sensitive because sometimes people want to pay off the mortgage insurance in a single premium as well as buy down points. Well, that could be a problem when it comes to purchasing. You could end up exceeding the amount of costs that you can incur if you don't have some sort of offsetting credit to help you. Okay.
Yeah.
Hopefully that made sense.
Oh, it made great sense, man. Yeah. There are limits to all of this stuff. So, for example, how I mentioned before, this seller was offering a $7,000 credit towards closing costs to help buy down the rate. Now, a buyer can only be credited the amount of their closing costs and not a nickel more.
Correct.
So it limits what you'd be able to get in terms of repair requests or credit towards repairs. So yeah, there's two sides to this, no matter how you cut it.
Yeah.
But it's going to be really interesting as we see the rates going up. We're at 1.8 months supply, so inventory is still low. It's higher than we've seen so far this year, but it's still low. It's going to be really interesting to see how people get creative, how loan officers get creative, and try and make these things affordable while prices are still high, but the cost of the money is so high as well.
Yeah, and it's how do you balance all of that? Now, I'm personal. My buyers are out there putting in offers, being competitive, and they're being beat out in the market. Okay, so some of our borrowers have decided to convert to, instead of conventional financing, even though they have great credit, is to shift over to more of an FHA financing, and we're finding pushback on that from sellers because they're weary of taking an FHA deal. Can you talk a little bit more about that?
Which is so silly, yeah. So I would say easily half of my production has been with an FHA loan. And they close just as quickly as any other loan. There's a slightly more stringent appraisal process, but I mean, this is stuff that you would want to see anyways. If there's not an oven in the house, they want to see that the gas line is capped.
Yeah.
If there's peeling paint, they want to see that repaired, which are all things that we would look for anyways when we're purchasing a home, and we would ask for in a repair request anyway.
Yeah.
So yeah, the FHA loan product is, in my opinion, just as trustworthy and just as successful as a conventional product. Do you agree?
Yeah, I think it's a misconception that comes around a lot. Unfortunately, we've had a strong market where conventional financing has been king. Okay, and so just for our audience out there, a conventional loan only means is that you have a personal relationship with the bank itself. So the bank is not being supported, or their mortgage isn't being guaranteed by any other entity. So FHA, what they're doing is providing an insurance component to help the bank just in case something happens to you, that there is an insurance that covers them. So any of us that puts down less than 20% to buy a property has to pay mortgage insurance no matter what. FHA just allows you to be able to buy a property with less money down. That's the 3.5%. And they allow you to have lower credit scores without as much of a negative effect on your scenario.
Sure.
And that allows you to be able to buy better. It also allows you higher debt to income ratios. It allows you so you can stretch yourself a little bit further, which in this economy, in this time, it's important.
Yeah.
You know, I've got a lot of buyers that would love to stay within, 50% or less of debt to income ratio, but they're being pushed farther because the prices haven't necessarily adjusted completely to help them.
Really great explanation there. And the prices are not going to adjust dramatically unless we see a mass influx of inventory. Now, the big barrier to this influx of inventory now is that the seller then has to go and buy, but they've got this sweet 2.75 rate that they locked in 2020, and they don't want to lose that rate and then go and buy something having a 6% rate with a buy down.
Yeah.
So this creates more resistance to this massive inventory shortage that's been creating these massive equity gains over the last 10 years.
Yeah, and because of that, now you have the tension, right? So seller won't sell, buyer is struggling to buy. Prices won't go down because as soon as we're still experiencing it, there's still competition
Huge
on properties.
demand.
So, if it's priced right, still in the right area, you do get buyers that are attracted to that. So as we film this, as we're talking about this, people still need a place to live. And so there's still going to be that demand on our housing situation. Like you said, inventory being low just kind of really stresses things out.
Even though the cost of money had gone up significantly by the month of May 2022, home values were still coming in at record high sales prices. They went up by 1.7% month over month into May. And so we haven't seen a retraction in prices. We have seen retraction in the amount of eager buyers there are, but instead of having 20 offers, we'll have 3 or 4.
Yeah.
But yeah, so it's a really interesting time, and still, the best time to buy a home is when you're ready to buy a home. You can't wait for the market. How many people do we know that said in 2016, I'm going to wait for the market to crash.
Yeah.
I'm going to wait for the market to crash.
Yeah.
And their wives are looking at them with such a sour face right now.
Oh, yeah.
Because rates are up and property values have gone up by over 30% since.
Yeah. I mean, if you can accommodate the scenario in your budget, you're always going to be successful when it comes to financing and purchasing a property.
Absolutely.
Okay. Now, rates will go up right now. We'll have a season of this, but in the future, you'll see an adjustment. There's always been an adjustment.
Of course.
We always go back to the people who bought in 1980 when things were up at 18% from the interest rate. All things were going crazy for them, and yet people still bought, and they'll still look back and say that it was a successful purchase, that it was a worthwhile scenario, that they wouldn't have done it any different. They've got tons of equity, and market will still increase. Especially here in California, we're in a high demand market situation that you're not going to lose if you invest.
No.
Now, can I ask you to touch on one thing for me here?
Absolutely not.
I like how I said, would you investments. So investors, okay. it's an interesting conversation for your investors that are looking to cash flow, and what does it take to invest in California real estate? Because if you're financing a property, the interest rates are up so high. You know, that was one of the first components that the Fed really dug into was, you know, we're going to dial back on, you know, how much we buy as far as investments. And that affected investors' pricing scenarios.
Yeah.
And so we're looking at alternatives for investors with things like interest-only options so that we can maximize cash flow. But it is a struggle, I would say, for the newer investor, because I still see investors jumping on properties. There was a property in Hawthorne that was selling for $550, duplex property.
Yeah.
And the front unit was gutted. It was studs. It was
Oh, wow.
a 3-bedroom, 2-bathroom that had a fire, and it was down to the studs. My buyer submitted an offer at $575 for the property and didn't win it. And it ended up going up. I'm waiting to see. It's in escrow now. But I would say that the possible value after repair was somewhere at $975
Sure.
for this property.
Yeah.
And the possible rents were somewhere at $5,300 a month, right? $2,100 for a 2-bedroom, 1-bathroom on top of the garage scenario. It had its own garage. And the front house was 3-bedroom, 2-bathroom. And rental possibility was somewhere at about 32.
Yeah.
So 32 to 34.
Yeah.
Somewhere like that.
Hold on. Gross rental income was $5,500?
55.
Yeah. So that property is significantly undervalued at $550,000.
Exactly.
Yeah.
Right?
So
even skeletal.
yeah. So even if you got up into the 650 range and planned on putting 100 into it with 5,500 gross rent, you're still looking at a sound long-term investment. So, you know, it's very competitive even now in the investor markets. You know, there are people who quit their day jobs, you know, and moved into home renovation, buy, repair, refinance, repeat, you know, BRRRRs, like, and they're looking at this as their sole source of income. So if there's any margins there, they're going to be all over it.
Well, let's talk about that. Okay, so I want to use this as an example because we've lightly touched on investment, and I've had some investors. Young guy with him and his brother are buying investment properties, and you know, this is one of those scenarios I told them is a really good scenario. But I want to talk it through from the perspective of what would you recommend in this scenario? So you've got a property at $550,000. That's the list price,
Sure.
right?
Yeah.
It's everybody come in, we're going to take the highest and best offer. Okay. The front unit's gutted out, so there's nothing in there. There's no floor, no walls, no plumbing, nothing. Okay, it's gutted. It's down to studs. So it's probably going to take somewhere, let's say conservatively, it's $150,000.
Okay, 150.
Yeah.
Yeah, okay.
In order to get this up and be a standard rental that you could use. So $550 current price, $150 possible rental.
Put you at 700.
Okay. So we know we've got $5,500 in possible rent. Back unit right now is being rented for less than market value at $1,800. Only $300 less.
Yeah.
Okay. And that a lot of it had to do with the situation with the fire in the front house. They've been long-term tenants, so they kind of give them a little bit of a break.
Sure.
Okay. How do you structure this deal? Like, what is a good way to structure the deal? One, in other words, what would you say is a good price to offer on this property? Okay, one. Two, how do you advise someone they've got $250,000, $300,000, you know, to put down to purchase this property and to do the renovations? They're going to be hard money lending, and I'll touch on that, on the hard money lending side of things to kind of discuss that. What would you advise your client to do in this situation?
Okay, so first and foremost, this is a buy and hold, right?
Yes.
Yeah. So anytime somebody's investing, I always tell them, and this actually isn't me. I think this is Warren Buffett who says this. you put the money in knowing that you're not going to see it back for a long time. You're going to see fluctuations in the market. You're going to be able to live your life comfortably without that cash on hand for a very long period of time. So this is a long-term play, you know? And so what I would advise them is to, you know, seek something that will cash flow, you know, a scenario that will cash flow, but don't be dependent on that cash flow, you know? If you're ready to make this investment, you're ready to see that money go to work for you for many years to come, you know? But not expecting a big return. The markets are way too competitive to expect massive cash flow on pretty much anything right now, unless you're paying cash for the property, you know, because holding costs are so high, especially now. So if you're ready to make this long-term investment, then you're ready to create incredible posterity for your family long-term, you know, and long-term growth. And that's ultimately how you get rich, you know? Everybody knows about the get-rich-quick scheme type of thing, and they all lost their money in the crypto markets last week, you know, over the last month. Yeah. So there's no get-rich-quick scheme. This is a long-term plan for wealth and success. And then another thing that I highly advise is look at the guidelines and look at the city bylaws for rent controls and things like that, and see what limitations you have on your year-over-year improvement on gross income, you know, because some places it's severely limited, where other places it's not. In some places, there's a little bit more flexibility for landlords to change out tenants, which sometimes you have to do, you know. This is like the foundation of the conversation, you know, but ultimately it's a long-term deal, and you say bye-bye to your money until next time, you know, for quite a while, unless you plan on refinancing and reinvesting. In that case, you'll see it a little bit sooner, but you better reinvest it within 90 days of closing, or you're going to pay the tax man.
Yeah, and so let's talk a little bit about that. So in this situation, you have a hard money loan. Okay. What hard money means is essentially it's a private investor that's investing into you to fix and repair this property and to prepare it either for sale or refinance. They're short-term loan products. So let's take this as an example. You want to buy this property, you have $300,000 that you have to work with, and let's say you have savings, 401k, whatever else that you're not planning to use, but you can show that you have as far as assets. The investor is going to look at all your assets, your history of investing. So if you're new, they're going to be a little bit more conservative, and they're going to base their numbers on that. Typically, you're going to be putting down somewhere at about 25% to 30% for the down payment in order to finance this property. So if we take this, let's say you're seeing the numbers and you're seeing that the after repair value, after you've done all your work, is up at $975. Let's say $1 million in this case. So just kind of make the numbers easier. I've got $1 million in value, and for those who don't know, that's your equity position, right? You have that value, and the value is that minus the difference in what you finance. So in this case and scenario, let's say you went in at $600,000 and won it. Okay, that means now you have to put down 25%. That ends up
$150,000.
$150,000. So now you're financing $450 to start. $150 of your money went into the purchase of the property. Now you've got another $150,000 in renovation costs that you're putting in.
So you're at $300.
So you're at $300 now that you've put in. You're still financing $450. So altogether, money spent with what you financed and what you're actually out of pocket.
$750.
So you're at $750 right now. So
do you like how I'm doing the math for you?
Thank you. I appreciate it. Because this goes into the next conversation, is that when you look to finance, let's say you cannot be in a hard money loan longer than, most will be 6 months, some will be a year. You'll have a few that'll allow you to go 2 years in order
With
to get
some
the
nasty
project.
calls, like they're towards 24 months.
Yes, because they want to get paid back. This
Yeah.
isn't a long-term financing situation, so you now have to be able to refinance the property and make them whole and finance however much you're going to finance in order to get you to a place where you can actually pay them back and hopefully still be able to cash flow your current property.
Yeah.
That's been the challenge with the investors right now, because the question is how much do I go in on this property if in the end I have to refinance, and how much can I refinance it into, because investment will require at least 30% still of that value to still be in the property, especially when it's to units. They won't let you just cash out everything.
Yeah.
So you've got to keep 300,000 in. So in this case, in scenario, you can only finance the 700. So 700 you're financing, 450 goes to your hard money lender, and then 250 you may be able to get back into your pocket, so that you have, and so you can make yourself whole.
Yeah.
But that may not cash flow your property.
No.
Because now you're financing 700,000, your payment could be somewhere at about $6,400 a month.
And what's the rate going to be at when you refi into a long-term loan product?
Somewhere at about 7%.
Yeah. Yeah.
So cash flow is affected there. So in this case, in scenario, this goes now to say, how much do I push in on this property, knowing that those are going to be my outs? I have to assume as an investor that I'm not going to be able to make myself whole on this, on the refinance side. Even if the value's there, I may still be conservative and say I'm still going to keep in 200,000 of my money in there. And I'm only going to finance, let's say, up to 500, maybe 550 of it, so I can keep my monthly payment low, so that my property cash flows. I mean, does that sound about right?
Yeah, absolutely. Which goes back to where I started. If you need to be made whole within 24 months, then this game is not for you.
Yeah.
Yeah. This is a long-term play, and you have to be ready to put the money on the table and let it go to work for you for a long time for it to make sense. There are other markets where the cap rates are much higher, the capitalization rates. We can go into that a different day. But here, you're lucky if you get a 4 cap. And in other states, they won't touch anything less than a 6.
Yeah.
You know what I'm saying?
Yeah, and some of them are saying 10 in other states. They'll look at a 10 cap.
But here's the thing. We're talking about finite property, coastal property.
Yeah.
Close to business centers, places where people make real money. And you can go to Texas where they have infinite property, infinite land. They can build forever, forever keeping property values low.
Yeah.
So this is a long-term play. And if you play long-term in Southern California real estate, you cannot lose.
Yeah. And that's the important, I think, piece to keep in mind when it comes to investment, is you have to remember that you're in it for the long haul, okay? A lot of what we're seeing is if you're going to turn this around in 5 years, I say hold off, okay? Because of what you're having to put into it, the costs and the amount that you're putting down in order to make sure that this property's breaking even, that I wouldn't be looking at just a 5-year scenario. I would probably be projecting a little further out to 8 to 10 years, so we can cycle through things and you can see a better rate of return, and you can kind of figure out where your investment is there. And at that point, maybe pull out the equity and reinvest it into something else.
But let me devil's advocate here.
Okay.
So what are your options with your money? Your options are go to Vegas and and get cabanas, for a couple of months, which would be awesome.
Yeah.
Great life experience. Not exactly the smartest way to go. Okay, you can put it in the bank and it'll do nothing. You can put it in the stock market.
Yeah, lose your shorts.
Or you can put it into real estate where, so unlike residential, or I shouldn't say residential, unlike single family residences, the values and the price points on multifamily doesn't fluctuate based on market conditions. It fluctuates based on rental income.
Yeah.
So while, residential income does this, single family residences, that is, multifamily just does a clean linear line. As long as you're raising your rents or if you're not in a rent-controlled area. You know, it's just a clean line, you know, because it's all based on income.
Yeah, and I like having more doors or units versus the single doors just because of vacancies and
diversification of the investment.
Exactly. And, you know, it's in anything that you do, whether it's stock market or if you're going to go to Bali, whatever it is, you know, as long as you're making an educated choice on what you're moving forward with, you know, we'll never say that, you know, stock market is bad. We'll never say the real estate market is bad. It's all dependent upon your understanding of the market that you're getting into. And our hope is that we're providing some education, you know, some background for you guys. And I wanted to go over this scenario because, you know, I've got investors that are out there going, you know, do I jump in? It's like double dutch. They're like, do I do it? Do I do it? Is it good enough? What's the rental? And it all comes down to your numbers. You know, you got to understand your numbers. What is your goal and focus of investing into this? How does that play out for you? Can you afford to let this money sit there like that? Because if you're looking to get it back, then you may be biting off more than you could chew.
Absolutely.
In those scenarios. So.
Yeah, but you know, without risk, there is no reward. And so I wouldn't by any means tell somebody, you know, that they absolutely should not do something, you know, because I don't have a crystal ball that's going to foretell the future. But I think the sound approach is put the money in without any expectations of seeing it back for 60, 120 months.
Oh, yeah.
At least.
At least.
Yeah.
At least. I mean, that's why I think if in this market with these circumstances that, I mean, we're in a new economic cycle, right? 2008, you know, we had the downfall, Great Recession. Then we came around, now we've had a pandemic. So we're riding the wave of an economic cycle and things have to purge. You know, we've got to get back to, we've interjected so much money into the economy that the interest rates have to go up to balance things so that the Fed can have more control. God forbid something else happens in the future, or scenarios that come about, you know, we don't know. So this is evening out in the market, but it doesn't mean it's a bad scenario. You just got to manage your numbers.
Yeah. Shucks, I didn't save it in my notes, but I saw something really interesting when I was looking at data on InfoSparks within the MLS. And in 2012, there were 90,000 active listings in the MLS. And in 2022, we have less than 20.
And there's your competition. You know, that's why you've got buyers who have to compete for houses against their desire in some ways, shape, or form. And, you know, man, that's crazy.
Isn't that a crazy number? Okay, and then, but here's the trippy part. The home sales in May of 2012, with 90,000 homes on market, was less than the amount of sales in May 2022. Isn't that a trip? So with 90,000 homes of inventory, the total volume of sales in the California multiple listing service, the total amount of sales was less with almost 5 times as much inventory in 2012. Isn't that a trip?
Yeah.
It's just like the cycles of the market, man.
I'm thinking about
numbers,
it. I bought my house in 2012.
Did you?
Years ago, yeah.
Yeah, so you were one of the 20,000.
Yeah. Well, because, I mean, we were looking around and, you know, in Long Beach, you know, we found a place over there by 7th Street, south of 7th, by Eximino.
Yeah.
And it was a nice house, a little odd on the layout, but it was going for $410,000. And we skipped out on that one because of the layout was a little weird.
Yeah.
And we ended up getting this one at $450,000.
Darn, dude. Dang. You guys gonna be all right?
Yeah. It's like, oh man. Thank you, Lord.
It didn't have this pool when he got it for $450,000.
Yeah, no.
Just throwing that out there.
No, we've done a lot of work to the house, but we saw the investment and we put all in. And it was hard for us then when we did it then. It was like, hey, I'm going to give you everything I got, because our rate at the time when we bought was, I want to say it was almost, that one was 4.5% to 5%, somewhere in there.
Nice, man.
At that time.
That's awesome.
And it was on the high side.
4.5% in 450.
Yeah.
The high side.
Yeah. On the rate.
Oh, what we would give for that. You're just making people have animosity right now. You realize that?
I'm sorry.
Yeah, because
Thank you, Lord, for the blessing.
I send this to my buyers every time we do this, and I send it to my sellers just as like a market update, and the buyers are just like,
you.
they're gonna be very upset with you.
Thanks. Sorry about that.
So I wanted to ask you one other question about like the creativity and how people are being successful in purchasing homes right now from a financial perspective. What are you seeing in adjustable rate mortgages right now?
Well, we're looking at the pricing for it. I still lean a little bit more towards my investors for adjustable rate mortgages. The buy down on points is still high on that one, but if you can get seller credit help, it is definitely a viable option.
What's the advantage?
The rate difference. Okay, so today had an investor. He's buying an investment property. We were looking at the 30-year fixed for him, and with a buy down on the 30-year fixed, he was at 5.875.
Okay.
On a 5.
And that was a 1 point buy down.
So 1 point buy down.
Mm-hmm. And
then on the investment scenario for a single family home, 5 year. It's the 5-year fix with the 6 months of adjustable afterwards, every 6 months. That one priced out at 4.75, but he was paying down a boatload of points on that one.
Okay, so
it's
significantly more cash up front.
Yes.
But a significantly reduced rate.
Yeah, it was less than an interest rate less on him. Mm-hmm. But he's not financing all that much. He's putting a lot down, heavy down payment on this scenario. He's got great credit scores, but it's still high on the interest rate scenario for him. And I shopped that one around. I looked everywhere to see if we could get any lower. I had a primary residence borrower putting down 5% and was very blessed to find an adjustable rate at 3.75. And this was like a month and a half ago. So factor that in. But he found 3.75 with his credit union and did great with that. And it was the 5-year fixed with the adjustable afterwards. So certain scenarios seem to be pricing out better. They come and go. Certain investors are trying to really, drive hard of getting deals and, really buying into it. I know Bank of America sometimes does that, where if you have an account and you have more than $500,000 invested with them, that they want to keep your business there. So they'll sometimes, really give you a lean interest rate.
Julio, can I borrow $500,000?
Yeah, sure. Let me see where I get that from.
Do you think Angie might have it?
Yeah, I know. I don't. If she's the accountant. So, but those are the things is that, those are situations where those scenarios kind of work in people's favors. But creativity. So let's touch on that. So the adjustable rate mortgages is definitely something you can think about when it comes to buying a property.
It doesn't seem like the advantage is like really significant, though. Do you?
No, I haven't seen it be.
And the potential balloon in 5 years is also scary.
Yes. So that's the hard part. I like the 7 and 1 or 7 and 6 arm. That means it gives you 7 years of a fixed period with the adjustable afterwards. 5 years just feels a little too short for me. 7 years, I feel like the market's going to be changing enough where you should have some flexibilities of options. But once again, we don't own a crystal ball, so we don't know what this looks like. But just based off of market trends, if you look at 7 years ago from today, that was 2015, interest rates were in the 4%. If you look 7 years before that, that would have been 2008. you know, the interest rates were high.
Yeah.
And because they were coming off of the downturn in the market. 7 years before that, that was 2001. So, I mean, you start looking back 7 years per date, and you're going to see that the interest rates are always going to be somewhere at about anywhere between 4 to 6% on the rates.
Yeah.
So if you're getting something on a 7-year, you have some time to weather the storm, and you're probably going to be in the pocket of the same scenarios. You're not going to be up at like 8, 9, 10%. Technically, you're going to be somewhere lower.
Yeah.
So,
Yeah.
yeah. So I like the gamble more in the 7-year
Sure.
adjustable rate option versus the 5, especially in our current stance. I would say maybe next year, the 5-year feels a little bit better. 2023, 2024, 5-year adjustable rate mortgage might feel a little bit better because it feels like we'll have some steadying effect of the market. So in the next couple of years, those might price out better, but 7 and 6 feels better right now.
I read something really cool. Just remember, you're marrying the property, not the interest rate.
Yeah. Oh, yeah. Yeah, don't tie yourself down into that. I mean, a lot of people do, and they kind of tighten up because they think like, oh my gosh, this rate. It goes back to the payment. You know, most times you'll forget what interest rate you had after you've been making payments. You'll always remember what your payment is per month. You'll, oh yeah, I pay this much per month. And in the future, there's always going to be opportunities to be able to refinance the property, and whether that be to, you know, spread the butter a little bit thinner, you know, that principal goes a little bit lighter, so help try to lower your payment in that scenario. Or if you're looking to pay off the property sooner, there's always adjusting it to a smaller rate or smaller loan term in hopes to get a better rate scenario.
Sure.
So options there will always be flexible. You just have to talk with your team. You know, your people that will help you understand how to navigate those scenarios with your home.
Yeah, absolutely, man. So we touched on everything that I wanted to discuss today. Was there anything else that you wanted to touch on?
No, I think we went over a lot. I really wanted to talk about investments today, and I know we really went a lot through that, and I think next time we'll talk about a little bit more like cap rate and investment products, because I think our audience would probably want to hear a little bit about that, because I know we do have investors that do listen to us and follow us. So I'd love to kind of get some of that information out there to them.
Cool, man. I'll be ready for it.
Okay, next time.
Awesome. Thanks, guys.
Thank you. See ya.